Welcome to Market Ike Basics. If you have ever listened to a trader speak and felt like they were talking in a completely different language, this video is for you. Today, we are breaking down the most widely used terms in trading and investing, explained simply and clearly. Think of this as your trading dictionary. By the end, you will be speaking the language of trading with confidence. Let's get into it. Bull and bear. Let us start with the two most famous animals in finance. A bull market is when prices are rising, optimism is high and investors are buying. The term comes from the way a bull attacks, thrusting its horns upward. A bear market is the opposite. Prices are falling and investors are selling. Bears swipe their paws downward. When someone says the market is bullish, they expect prices to rise. Bearish means they expect prices to fall. You will hear these every single day. Long and short. Going long means buying because you expect price to rise. Going short means selling because you expect price to fall. Simple as that. Two directions. Every trade you ever place will be one or the other. Bid, ask, and spread. Every asset has two prices, the bid and the ask. The bid is what buyers will pay. The ask is what sellers will accept. The difference between them is the spread, the built-in cost of every trade you place. Tighter spreads mean cheaper trading. Always factor the spread in when planning a trade. Pip and tick. A pip is the smallest price movement in forex markets, typically the fourth decimal place. A tick is the equivalent in commodity markets like gold, the minimum price movement of that asset. When we say gold moves $1 per tick in our paper trading videos, we are referring to the tick size. Understanding these helps you calculate profit and loss precisely. Lot size. A lot is a standardized unit of trade size. Standard lots are large, suitable for bigger accounts. Mini lots are 1/10 of a standard. Micro lots are 1/100th. As a beginner, always start with micro or mini lots to keep your position sizes small and your risk controlled. We will cover lot sizing in much more detail in a future dedicated video. Leverage and margin. Leverage lets you control a position larger than your account balance. 10-to-1 leverage means $100 controls a $1,000 position. It amplifies both profits and losses equally. Treat it with extreme caution. Leverage is one of the leading causes of blown accounts. Margin is the deposit your broker requires to open a leveraged position. If your account falls below the required margin level, you receive a margin call. Your broker closes your position automatically. Margin calls mean risk management has broken down. Avoid them at all costs. Liquidity and slippage. Liquidity is how easily an asset can be bought or sold. Highly liquid markets like gold and major currencies have tight spreads and fast execution. Always trade liquid markets as a beginner. Slippage happens when your trade executes at a slightly different price than intended, usually in fast-moving markets. Another reason quality brokers and liquid markets matter. Market orders and limit orders. A market order executes immediately at the current price. Fast, but no price guarantee. A limit order executes only at your specified price or better. Price guaranteed, but execution is not. Most traders use both depending on the situation. Stop loss and take profit. A stop loss automatically closes your trade at a predefined loss level, protecting your capital. We have a full dedicated video on stop losses. It is one of the most important videos on this channel. A take profit automatically closes your trade when your profit target is reached, removing the temptation to hold too long out of greed. Every trade should have both a stop loss and a take profit set before you enter. Volatility and drawdown. Volatility measures how sharply and quickly prices move. High volatility means bigger moves and bigger risk. The ATR, which we covered in a dedicated video, is one of the best tools for measuring volatility on your time frame. Drawdown is the reduction in your account from its peak to its lowest point during a losing period. A 50% drawdown requires a 100% gain just to recover. This is why keeping drawdowns small through disciplined money management is so critical. Risk to reward ratio. This compares what you risk on a trade versus what you aim to make. A 1-to-2 ratio means risking $30 to make $60. The higher your risk to reward, the fewer trades you need to win to be profitable overall. One of the most powerful concepts in all of trading, covered in full in our money management video. Confluence. Confluence is when multiple signals point to the same conclusion at the same time. Price at a key support level, RSI showing oversold, and a bullish candle forming. 3 independent signals agreeing. Confluence increases trade probability significantly and is something experienced traders actively hunt for before entering. Breakout and consolidation. A breakout is when price moves decisively beyond a key support or resistance level. It can signal the start of a significant new move. False breakouts, where price briefly pierces a level before reversing, are common and catch many beginners off guard. Always wait for a candle to close beyond the level before acting. Consolidation is when price moves sideways, neither making new highs nor new lows. A pause in the market. Consolidation often precedes significant moves in one direction. Experienced traders watch these zones closely. Support and resistance. Support is a price floor, where buyers have historically stepped in and stopped price falling further. Resistance is a price ceiling, where sellers have pushed price back down. These are among the most important concepts in all of technical analysis and appear in almost every trading strategy. We are dedicating a full video to these in a future episode. FOMO and FUD, 2 psychology terms you will encounter constantly. FOMO, fear of missing out, drives traders into positions simply because the market is moving fast and they do not want to miss it. FUD, fear, uncertainty, and doubt causes panic selling and missed opportunities. Both are emotion-driven. Both are the enemy of disciplined trading. Trend, the overall direction a market is moving. An uptrend shows higher highs and higher lows. A downtrend shows lower highs and lower lows. One of the oldest principles in trading: the trend is your friend. Trading with the trend dramatically improves your probability of success. Paper trading. Practicing in real market conditions with virtual money. No real capital at risk. The single most recommended starting point for any new trader. We covered this in a full dedicated video, and the link to TradingView's free paper trading account is in the description below. Final thoughts. That is your core trading vocabulary covered. These terms will appear constantly on charts, in videos, on broker platforms, and in conversations with other traders. The more comfortable you are with this language, the faster everything else will click into place. Every term we covered today has a deeper story behind it, and many of them we have already explored in dedicated videos on this channel. As Market IQ Basics grows, we will continue going deeper into all of these concepts in future videos. Keep learning, keep studying, and keep building your knowledge one video at a time. If this helped you, please like, subscribe, and share with someone just starting their trading journey. See you in the next one.